Some of the worst multifamily deals I see are built in locations that look perfectly fine on a map. Good price, available land, strong projected rents, and yet they struggle. Not immediately, but over time. In this video, I want to show you how I read an Edmonton corridor before I believe the rent story. Because the difference between a good deal and a struggling one often comes down to how demand behaves at the micro level, not the city level. If you're new here, I'm Darren from DK Wealth and Growth. And if you've been following along, you know we focus on disciplined CMHC-eligible multifamily investing, especially here in Alberta. And stay with me until the end because I'm going to show you one location factor that can make a deal look strong during lease-up, but quietly hurt your exit later. Most investors evaluate location at the city level. Edmonton is growing, population is increasing, rents are strong. All of that can be true, but it doesn't tell you what's happening on the specific corridor you're buying into. Because within the same city, you can have one area where demand compounds and another where supply quietly overwhelms it. And here's the key. Your returns don't depend on the city. They depend on the exact corridor your building sits on. The first thing I look at is nodes, employment centers, universities, hospitals, transit connections. These create consistent tenant demand. But here's where investors get caught. Transit alone is not enough. Transit can help lease up, but it doesn't always guarantee long-term tenant stability, and it definitely doesn't guarantee strong exit value. Next, I look at future supply. What's being built nearby? What zoning changes have been approved? How much competition is coming online? Edmonton has already streamlined zoning, and with more priority growth areas being activated, supply can increase quickly in certain corridors. And when multiple buildings hit the same corridor at once, lease-up slows, incentives increase, and pricing pressure builds, even if the overall city demand is strong. Then I look at exit quality. Not just can I rent this, but who will buy this building later? Will this corridor still be desirable in 5 to 10 years? Does it attract long-term capital or just short-term interest? Because the same feature that helps lease up today can limit your buyer pool tomorrow. That's the trade-off most investors miss. Short-term demand versus long-term durability. And that difference shows up at exit. So when I evaluate a corridor, I'm not asking, is this location cheap? I'm asking, is demand anchored here? Is supply controlled? Is the tenant base stable? And does this corridor hold value over time? Because that's what determines whether the rent story actually holds. A cheap site can still become an expensive mistake. A strong corridor can carry a deal even when conditions change. That's the difference. If this kind of disciplined approach to evaluating multifamily opportunities resonates with you, make sure you subscribe to the channel. Each week, I break down how serious investors evaluate CMHC-eligible deals, from location to structure to long-term performance. And next week, I'm going to show you something that catches a lot of investors off guard. Why turnkey deals don't actually exist unless the entire operator stack works, from development to management to execution. If you want to explore opportunities where corridor selection is already stress tested, you'll find links below where you can join the investor list or learn more. Thanks for watching, and I'll see you in the next video.